Two major things happened in the world of DeFi, decentralized finance, last week. BlackRock made its first formal move into DeFi, listing its $2.18 billion tokenized treasury fund on Uniswap and buying a stake in Uniswap's governance token. Just a few days later, $292 million disappeared from a DeFi protocol in less than an hour, 46 minutes to be exact. That caused $13 billion in market value to be wiped out over the next few days over the weekend. That money is completely gone and nobody can get it back. Both of these headlines are true and they show the underlying tension between traditional finance adopting blockchain and what's happening in DeFi. These are two different worlds. DeFi is instantaneous settlement with bearer assets that removes all of the friction of the financial system, and TradFi is really quite the opposite. So where does this leave us? And how do we resolve this tension as Wall Street continues to think about how they adopt blockchain and how DeFi thinks about maybe TradFi has it right? That's what we're going to be talking about today. Welcome to Money Moves. So when we talk about institutional adoption of blockchain, that can actually mean a lot of different things. There's blockchain adoption that sits very firmly within regulatory bounds and is simply upgrading the current financial system, technology rails. Then there's DeFi, and DeFi is really like the Wild West. This is where the cowboys live. Many participants in DeFi think that there is a future world in which you don't need banks and you can completely operate outside of the banking system, for example. So Dave, we're going to start with you today. Walk us through all the different types of blockchain-enabled financial products, from DeFi all the way to the most vanilla TradFi instrument and everything in between.
Let's talk about decentralized finance and the spectrum of decentralized finance. On one far end of the spectrum, let's call it the right, nothing political about this, you have what I'd call sort of the Star Wars cantina of decentralized finance, where it's, as Samantha said, a lawless, completely free, permissionless ecosystem where financial services, borrow, lend, investment, exchange activity is governed completely by code. So these are increasingly big parts of the crypto ecosystem. This is what people typically think of when they think of DeFi. Things like Aave, Uniswap, Morpho, Camino, Euler. There's a whole number of these basically marketplaces where people come together through code to swap assets, to lend to each other, to borrow, to perpetuate interest rate swaps, perpetual futures. There's a huge number of financial instruments that now live in this sort of completely free and permissionless world. On the other end of the spectrum, you have institutional DeFi, which has really only come about in the last, let's say, 1 or 2 years, where you now have large institutions like BlackRock, like Franklin Templeton, like WisdomTree, who are issuing traditional financial instruments, money market fund shares, ETF shares, private credit fund shares, as blockchain-based tokens. And those tokens are now being used in decentralized finance applications. An example of that is Athena is a decentralized hedge fund, essentially, is what you could consider it. They invest in a money market fund that's actually tokenized by BlackRock. So that's the kind of like cross-pollination that you have. And then you have literally everything in between. That world is essentially, the trend is that both ends of those spectrums are converging and coming together. So you have people on really the far institutional side playing more in the Star Wars cantina, as it were. And then you have people in the free and permissionless and fully decentralized world who are now using instruments and assets and utilities that are being perpetuated and issued and created and supported by large institutions. So it's a really interesting convergence at the middle that we're seeing.
So Ian, when you think about all your Wall Street bro friends and
There,
they
there,
hear,
there, there, there are women on Wall Street, Samantha. Just to be clear.
oh, I'm very aware, just not as many.
Okay.
Just not as many. So when people are thinking about engaging with this ecosystem, do you think that there's a real understanding of the difference of this, or the levels of decentralized finance you can get to?
No, no. I think DeFi is a really small part of the financial ecosystem in the context of the broader financial ecosystem. I think one of the reasons that we gave rise to crypto and blockchain and DeFi and all of this is because so much of the world was not covered by the traditional financial system. If you go to a really hot tech startup in New York, where there's a lot of young people in their mid 20s, many of them are not accredited investors. Their ability to invest in private companies is prevented by the federal government. So you've got really smart people with serious educations that work really hard and are thoughtful that are unable to invest in private companies. You've got people around the world for whom it is very hard to have US dollars. You have people around the world for whom it's very hard to get money out of their country's close to capital accounts. DeFi is an expression of the individual's ability to transact more freely. It's particularly important for those that are unable to transact the way they want because of where they are or who they are. Now, that sounds great, but in the Wild West, in the Star Wars cantina, you're going to see all kinds. And we've seen all kinds really come to the fore of attention during DeFi summer. Was that summer 21, summer 22?
21.
Yeah.
21?
When
Okay.
everyone got their stimulus checks.
Yeah, so we're 5 years on from DeFi summer, and the best takeaway I think from DeFi summer is it spawned a lot of technology that works and can be repurposed elsewhere. I think in the last 5 years, you've not seen the DeFi adoption that people had hoped in DeFi summer.
I agree with that. And I think so as the past 3 episodes, we've been celebrating, one, the access that blockchain-enabled financial products bring to everyone around the world, and like Ian said, even US investors who are not accredited. We've been celebrating the features, as Dave also said, sometimes the features can be the bug, but we've been celebrating the features, like these are bearer assets, and you have instantaneous settlement. So we all very much buy into the idea that you can move value across the world in seconds outside of the banking system is a major upgrade and is a very good thing for the world. But over the weekend, there was a major exploit. I already talked about it earlier in the show. That shows the other side of that coin. So let's kind of walk through. I want one of you guys, whoever wants to, walk us through very simply what happened, and then we'll get into the implications this has for the crypto community and what that might mean for TradFi adoption.
Well, I'm happy to do that. And it's funny because there is no simple way to explain it. That's part of the reason why we'll explain what happened, why it was such a big mess. And I'm actually going to read a tweet from Chainlink God, a guy named Zach Rhines who works for Chainlink. And when he posted this tweet, he did it with a picture of the guy that's explaining synthetic CDOs to Steve Carell in The Big Short when they're eating sushi. So imagine I'm that guy when I'm reading this tweet. Look, guys, it's actually really straightforward. A bunch of people staked their ETH on Ethereum to earn yield, except they didn't want their capital to be locked up, so they actually staked with a liquid staking protocol called Lido, who provided them a liquid staking receipt token called staked ETH, except they decided to juice their yield further by depositing their staked ETH receipt tokens into a restaking protocol called EigenLayer, except they didn't want to lock up their capital, so they actually restaked with a liquid restaking protocol called KelpDAO, who helped provide them with a liquid restaking receipt token called RSETH, except they decided to juice their yield further by depositing their RSETH into a lending protocol called Aave, so they could open a leveraged looping position that borrows ETH against the RSETH and restakes the ETH into RS-ETH, which then is deposited as collateral, except for the RS-ETH used a cross-chain messaging protocol called Layer 0 that allows you to move blockchain assets from one network to the other. And North Korea basically hacked that bridge and was able to print fake RS-ETH, borrow ETH against it, which basically created a contagion because now you have RS-ETH, which is uncollateralized or under-collateralized. You have now bad debt and Aave, and all these people that looped into this insane sort of recursive position can't unwind themselves. That is essentially what happened. And it was a $300 million hack. So they created $300 million of fake RS-ETH, and they were able to withdraw $300 million of real ETH and then mix that through a bunch of mixers and things like that. Basically, their friends at the Star Wars Cantina helping them, with some untoward things. But that contagion, because everyone in the industry depends on Layer 0 for cross-chain bridging, people thought that this compromise could be repeated in other markets. And so you essentially had $15 billion in outflows, all the major sort of DeFi money markets freeze up. And the cherry on top was that you then had Arbitrum, which is a blockchain network where some of the stolen ETH was withdrawn to, decide to, and we all know blockchains are just public ledgers and they should be decentralized. In this case, a group of people that control Arbitrum actually stole the money back from the hacker by updating the Arbitrum ledger to say the hacker no longer has it. And so this highlights a whole bunch of things that we should really talk about. Like, are blockchains really decentralized? Is DeFi safe? Is it ready for the masses? Why are people even doing this kind of thing? What value does it bring?
Maybe TradFi has a few things right? On certain controls that can happen before contagion can happen. I'm not saying it's always right, but how does DeFi adapt to make sure that it can be more safe for the masses? Because the real situation is right now there are a lot of people that had money in Aave, which Vitalik called safe DeFi like a month ago. He was basically now saying DeFi is safe, and it's because of Aave and other lending protocols like that. And their money might not ever be recovered. That's pretty serious.
Well, yeah, it definitely won't be recovered. And
it won't be recovered, but people are trying to talk about if they're going to make them whole.
Yeah.
That's a major debate going on. Yeah.
So a lot of what we saw, and I think a lot of the dynamics that I just described, people that lived through the GFC would find familiar, where you had basically, Geithner, who was the New York Fed governor and then the Treasury Secretary, he famously said that the banks weren't too big to fail, they were too interconnected to fail. And that is essentially what's happened in DeFi, where you now have so much interconnectivity, bridging, cross-collateralization, borrowing, lending, looping, all of these things have become so interconnected that one failure or explosion, like in GFC, it was Lehman or Bear Stearns, kind of triggers this brush fire that sweeps through everything and everyone that's connected.
Let me sort of poke at this a little bit. So the nexus of risk here was at the Layer 0 bridge. And the three of us are in this industry, so I'm sure we're going to be more diplomatic here than we should be, just about all of these players. So to everybody watching this, reach out privately. We'll tell you what we really think. But I'm only partially tongue in cheek. But the bridge itself was the nexus of risk. And why could something like a bridge be the nexus of risk? It's because so much of the liquidity across blockchain and Web3 and crypto and DeFi is fragmented across different blockchains. And because of that, there needs to be a way to connect what are effectively sort of quasi-tribalistic networks. That's because we built a lot of blockchains before we built a lot of blockchain applications, and a lot of value accrued there. And a lot of things were done by blockchains to incentivize attention and capital accrual and a behavior that has left people saying, okay, well, I'm heavily invested in this one blockchain. This one blockchain's got billions of TVL or billions worth of market cap and it's governed in this token, but I want to do things across other blockchains. But once you open up the concept of the bridge between two blockchains, to some extent, you've eroded the endogenous security that exists on the public blockchain. So the first thing that I sort of take away from this is, with all of these different blockchains, what have we achieved if the liquidity is so fragmented that we need bridges and those bridges themselves are not decentralized? And so layer 0 is not decentralized, and there was a single point of failure, and the bridge was in demand to be used because it was the way in which you bridged across the liquidity from the different blockchains. So the first question in comparing DeFi and traditional finance too is, if you look at market structure, you don't want to fragment liquidity. You want liquidity to be in the same pool to the greatest extent possible. I'm not saying in one institution, but in one global pool of capital to avoid this fragmentation. It's in this fragmentation that you see low liquidity, you see slippage, you see attack vectors, you see risk. So I think one thing that we can take away from this is, what is the role that bridging plays in decentralized finance? Why is it so important to decentralized finance? What does it say about the fragmentation of liquidity across decentralized finance? So that's sort of one comment I'd make about the kelp situation. The second comment I'd make about the kelp situation is that these applications, whether it's Aave or others, are beholden to their own governance structures, whilst other blockchains or blockchain applications like Bitcoin do not have that same framework. Many of the applications that people rely on and take this, libertarian attitude towards are very easily controlled. Tether froze 350 million, I think, or so worth of US dollars in the past week. I'm sure my guess would be that they were prompted to do so by information that came from a state actor. Good reason, bad reason.
Though? I don't think Circle did, right? I'm pretty sure Circle chose not to freeze anything, which was a big, major conversation point this week too.
Yeah. So, but I think there's more discretion here than we can appreciate. Now, going back to where we've evolved in DeFi, so that's where I think we are with Kelp. I think we should really ask, what is the role of the governance and the decentralization at the application layer? Because it's really important for users. And the second is, what's the role of the bridge as it applies to the security of blockchain DeFi-based finance in general? And I think those two issues are ones that I think everybody who wasn't educated on them got a lot more educated over the last week.
I think, just taking your 2 points in turn, bridges are important and good. And there's debate over, in terms of how the hack actually happened. Layer 0 says it was KelpDAO's fault. KelpDAO says it was Layer 0's fault. And then I think Aave is blaming everyone.
So sorry, let's just clean up a little bit. So KelpDAO ran Layer 0 bridge technology in its application.
Yes.
And the way in which it configured the Layer 0 technology is where the debate lies. Could KelpDAO have configured that technology in a way that was more secure, or did KelpDAO configure that technology in the way that was recommended by Layer 0? I think that is the debate.
That's the debate. That's
okay.
The debate.
But nonetheless, when KelpDAO is in a position to make a discretionary decision around the configuration of the bridge, you've created a security vulnerability for users broadly that is greater than simply staying within one blockchain like Ethereum or something else to do your business.
The reason why, there are far too many blockchain networks, far too many. Most of them were launched because they come with a token and people wanted to sell that token and make money off the price of that token appreciating. Let's be realistic. That's why most blockchains have launched. But needs to be more than one. And I'll tell you why. Because there are so many different use cases. One blockchain could never be fit for purpose for all of them. So, like the Bitcoin blockchain could not support DeFi, right? The Ethereum blockchain now has smart contracts, whereas Bitcoin didn't. So you can now, Ethereum becomes essentially this big decentralized computer, and you can do a whole bunch of different things on it. But then Ethereum was, many say, too slow, right? It can only process 50
And expensive.
and expensive, right? And so then you get Solana, and you get Avalanche, and you get Arbit, and so then you get all these different blockchains which are basically optimizing, in terms of, like, they call it the trilemma, which is decentralization, speed, and security, right? Where you're kind of always, it's a zero sum game where the less decentralized are, the faster you can be, but the less secure you are, and the more decentralized and secure you are, you can't be as fast. They're all kind of playing around with those different sort of design decisions. It's good to have multiple because they can meet the requirements of specific applications, and bridges exist to make it so people can move between these different ecosystems seamlessly and supposedly securely. But obviously, I mean, what we've seen is that a lot of the I don't know if it's the majority, but so many of the biggest exploits. By the way, this exploit is actually relatively small on the grand scheme of things. It's big because
It's small, but I think it's incredibly important to the ecosystem right now because of all
because of how
that's happening
interconnected
because of it. Yeah.
because of how interconnected everything is. So from a monetary perspective, it's small, but from a contagion perspective, it's big. Um,
And implication perspective potentially.
and people need bridges to basically move between those networks. So bridges aren't inherently bad, but they are single points of failure, and they do get hacked. And I'm sure there's a lot of PhDs in cryptography and decentralized systems that are working on solving some of these problems. But I don't think that they're inherently bad. They just exist because of this. And look, the internet has these things too. We take this all for granted, but behind the video we're recording on today are complex webs of transatlantic cables and content delivery networks and ISPs and switches and routers. And I mean, there is a lot of bridges in the information internet, right? Just as there are and will continue to be lots of bridges in the financial internet that we call blockchain. So I just don't think that they're inherently bad things.
So I think what we're showing through this part of the conversation is just underlying what Dave and I have both said, right? Which is this is the Wild West. There are many different types of people you can choose from to work with, many different types of protocols. What Dave didn't even go into is that then there's layer ones and then there's layer twos on top of some of these blockchains like Ethereum. And that's where some of these problems lie. And so that would take hours for us to try to really walk through DeFi ecosystem. I want us to really focus though on the nuances of, because of this exploit and because it exposed vulnerabilities in our DeFi world, of which all of us are working in a hybrid world. Really, none of us, from a company perspective, are living fully in DeFi. And so I think it's an important point to talk about where those trade-offs are, not necessarily on the technical build, like you just walked through on the trilemma, Dave, but what are the trade-offs whenever TradFi institutions are thinking about coming into blockchain, and where should they be? Let's just talk about the trade-offs. Let's start there.
So I'll make basically the argument or the logic behind the completely permissionless world. So essentially the thinking goes like this, that regulation and intermediaries and third-party dependencies are bad. And so we need to create a space where people have complete freedom to design financial applications and markets and applications and operate within them and transact with others completely free and devoid of regulation, rules, intermediaries, oversight. And that this freedom will create financial innovation that we can then import into the mainstream regulated financial markets and used to make those mainstream financial markets better. So I think it was actually before FTX went down, he was pretty close to getting the CFTC to adopt some of the concepts around collateral movement and perpetuals trading, perpetual futures trading, and I can't remember specifically, but they were pretty close. They were looking at this DeFi ecosystem and basically saying, wow, there's a lot of like innovation that's happened here, some really cool financial primitives and ideas that we could use and import into the mainstream financial markets. And so that's the good. The downside is that when something goes wrong, there's no one there to save you or to help you. It's like, if a bank fails, we have FDIC insurance. If you missend a wire, there's a way to reverse it. If someone steals your credit, I mean, there are ways to reverse and fix things and to police things and to regulate things in the mainstream sort of centralized financial markets that provide a level of forgiveness or provide room for error and how to rectify those errors. In the DeFi world, as we saw, and as we've talked about previously, because there are no cops, because these are bearer instruments, when they're gone, and when they break, they're broken. And really, it is just the will of the people on the internet that kind of uphold and maintain and develop these things to try to put in place some solution. Like Arbitrum, they reversed a transaction. So they decided, and we should talk about, are these decentralized things really decentralized? Because there's an interesting argument there where 12 people in Arbitrum governance council said, you know what? We are going to step in and we're going to exercise our authority to reverse $71 million of the stolen Ethereum. And so that's kind of the two sides. And there are pros and cons with both, right? And I think what we're seeing and the benefits we're seeing is it's actually good to let these things develop unimpeded and unimpaired and free, because then we can look at what works and what doesn't and import those ideas and those concepts into regulated and more controlled settings and use them for good.
Totally. I think that is to me the most important point in this subject. The biggest takeaways from DeFi Summer 5 years ago was the innovation of and the hardening of really core technologies that I think now will be adopted in the institutional space. We can take, and obviously this is an important part of the Profiter framework, but we can take the technologies that are proven and known and have been R&D'd and battle tested for years and bring them into a permissioned, walled garden institutional landscape. And that is very, very valuable. Instantaneous settlement, composability, trustlessness, these are hugely valuable and productivity gaining for institutions, and they would not exist today and be prime time ready without the innovation that has existed in this permissionless universe. So I think that's incredibly important, and we've talked about in the prior call, this sort of innovation, this kind of entrepreneurship. Freedom isn't free, but it's the best alternative, is starting to pay real dividends. It's not only paying real dividends in institutional adoption, maybe parochial institutional adoption, but institutional adoption nonetheless. It's also paying dividends in the strength that the community has gotten vis-a-vis Washington, D.C., so East Coast law. And that's now come through in what I think is at least as important as what happened with Kelp DAO last week, probably a lot more important, which was, on April 13th, the SEC came out with a staff statement regarding broker-dealer registration of certain user interfaces utilized to prepare transactions in crypto asset securities. Anybody who's listening to this podcast, find us on the internet. We will send you this link from the SEC. I think it is a really big deal. It is such a big deal that I'm going to read a rather dry paragraph and then I'm going to explain it. And I think it speaks to the innovation point that Dave just highlighted, which is we've innovated in these places. They get adopted institutionally. The community becomes stronger, and thus it changes the rules of the road for everybody in a way where in 10, 20 years, we may even forgot how we got there. But we got there through this petri dish of freedom. So for purposes of this statement, a cover user interface is an interface provided by a website, browser extension, or other software application, e.g. mobile application, that may be embedded in a wallet or separately available for download, designed to assist users engaging in user-initiated crypto asset security transactions on blockchain protocols or blockchain-based smart contracts, utilizing the user's self-custodial wallet. Covered user interfaces typically provide functionality with respect to any type of crypto asset transaction. Statement addresses the use of covered user interface for crypto security transactions. What does this mean? This creates a new framework for covered user interfaces, effectively building an application layer that can sit on top of peer-to-peer DeFi and inclusive of securities. This was not the rules of the road until April 13th. That was like last week. Like that, this is like game changing. It basically means that folks like Dave and I can build and innovate, and you, Samantha, can finance, and everybody can use an application that sits on top of peer-to-peer DeFi-like, DeFi native frameworks. Now, we can't solicit a particular security to be bought or sold. There's a lot of things that can't be done. But what can be done now is we can think of building a user interface on top of these DeFi applications. And that's a big deal. And that's a really big deal. And it will likely mean that this whole universe where people wouldn't invest before, build before, institutions didn't want to play before because the rules of the road were unclear. Now there's more clarity. Now there's more coverage from a governance perspective. And I think we will see these technologies developed in this freedom petri dish come to the fore really quickly. There's a very large venture capital firm, I don't want to say their name, who I think, the SEC worked closely with in adopting this. And I think it's a really big deal and speaks to the point that Dave was making.
So there's and this goes back to the question. I'm glad that you read that. It is a big deal because the counterfactual is that people providing these interfaces to DeFi, there was a question that potentially they could be regulated as broker-dealers, and that would essentially kill innovation because these are tech companies and it's impossible to register as a broker-dealer, and there's all types of crazy requirements around capital. And it's just the old argument of being regulated is hard and expensive, and some people would say that's by design. But now that interfaces into DeFi, software web applications, that would allow a user to interact with these decentralized finance protocols and markets, they're not registered broker-dealers. Let's play that out in light of what we learned with KelpDAO. I would say the reason why it's okay everyone doing that crazy KelpDAO trade, these were not regular normal people. The people that lost their money in this trade knew the risks that they were taking. They may have said, "Oh, we didn't know that this." They knew these are highly sophisticated people. These aren't mom and pop. This isn't the retiree. This isn't grandma and grandpa. I mean, I'm sure there are.
You can't just log in. I think the point is this. The user experience is not such that just anyone with an internet connection really can just log in and buy. Like right now on Coinbase, you can buy and buy Bitcoin very easily. That is not the case when you are interacting in deep DeFi. You go through multiple
staking and restaking and multiple vaults, and
what the SEC just did was make it easier for that world to change, where now you can anyone can build these applications, and if you play that out to the extreme, you could see grandma and grandpa putting their savings into a decentralized finance application or a DeFi money market, and so in that world, if it continues to be the Star Wars cantina and there's an exploit, then you have potentially the masses, people that didn't self-select to go into the Star Wars Cantina, people that were sort of brought into it without knowing the risk that they were taking. So there can be a big debate over
But
whether that's a good
but
thing or a bad thing.
but here's where brands matter. I think we forget, and we live in a world that's pretty safe. But brands have the value of connoting safety, and for the consumer is really, really valuable, right? Like, if you were imagine a world that doesn't have the FDA, okay, for instance, well, then you're going to really care about a brand, a proven brand that's been around 100 years, and you know that the food or the drugs that you're purchasing is clean and safety tested and the rest of it. And the best way as a user, when you go to reach for the product, is to tell by brand. Now, this happens in fashion, like, hey, LL Bean's a little bit better than like the Walmart brand, like fine. But it really matters in other domains, and especially matters in other domains that are less governed. And so I think what you'll start to see now is people really caring about brand. And, an episode or two, we talked about the role that banks played vis-a-vis stable coins and where their value accrual is. And, one thing that we talked about is they have that last mile relationship and that distribution, which is very valuable.
The pushback, though, to this, Ian, is that FTX was a good brand. Aave, no, I'm not saying Aave and FTX are anything close to the same, but Aave has been one of the best brands of the past, 18 months?
Yeah, I don't think that I'm thinking about FTX and Aave, and all due respect to Aave, in the same way that I'm thinking about where the world's going and the value of those brands vis-a-vis other players that are out there. Like you know, FTX had a very parochial brand. Many people in America had not heard of FTX until they blew up, right? I'm talking about like broad scope branding. And so what I wonder across financial services, and so I wonder if this kind of regulatory clarity means that another source of value accrual to larger financial institutions is to serve in this stead, leveraging the brands that they have. I will make this note on FTX and SBF maybe for another episode, but that venture capital portfolio that SBF and FTX had was unbelievable. And whatever was going on at FTX at that time is, noxious as it may have been in using client funds to support the trading book, which is basically what happened. They were making investments that were generational.
Well, it's not quite the same, but the former CFO of Enron came and spoke to my class when I was in business school at Rice, and he basically held up his, like, I don't know, did they give you dog tags in prison? Whatever they give you in prison. And he held up a broken trophy that he got from Fortune for being one of the best CFOs, the most innovative or best CFO. He was named, he was like on the cover. And he said, I got these two things for doing the exact same thing. That's his take. Listen, we can unpack that, but this is, I'm sure, how Sam Bankman-Fried is sitting in prison thinking right now.
I was literally going to say, to Ian's point, that Enron had a great brand. So it's really funny that you bring that up. But Ian, so basically your argument is that, or you're saying DeFi is great because it's a financial laboratory.
Yeah, I think we live in a free country that is dominant in large extent based on technology, and that technology requires a lot of freedom to support its innovation. And DeFi is part of that story. And now we have a regulatory framework that's adopting that, accepting that, and creating rules of the road for market participants to have greater clarity, as per the SEC last week.
Well, so you think, and then the SEC, their regulatory framework was basically to say that we're not going to regulate it. So they didn't really put rules in the road. They just said,
I mean, they've kept it.
They said we're not going to put rules in the road.
They didn't do away with the concept of a registered broker dealer. Obviously, I'm the CEO of one, so it's an area I'm familiar with. But they didn't do away with that concept. But they said that there is a new cohort, there is a new kind of player that can exist that we're okay with existing.
And so, if and when grandma and grandpa adopt DeFi, you're basically saying that trust and safety will be established.
I don't think that grandma and grandpa are going to adopt DeFi. I think what's going to happen is there are going to be, well, let's back up. what is the purpose of DeFi, right? If the purpose of DeFi is for there to be AMMs, so automatic market makers, that are providing liquidity in the governance tokens of other protocols and paying with the governance token of their own protocol. That's basically how they work. You take the governance token in one DeFi protocol, you stake it in another DeFi protocol, and you get paid for that staking in the yield of the governance protocol that you just staked in. That's not the best use case. That's Ponzi or Ponzi light, in the sense that there's not an end user there to be a consumer of the financial product a lot of the time. Okay? But where there is a lightweight way to generate real yield and real savings with a better technology to do this, I think that will feed up into financial products that investors will benefit from. And those technologies, to be made lightweight and peer-to-peer, have been designed and implemented and hardened in the DeFi world. And there's a lot of them. When those things that are real, that have the ability to truly financially analyze, where the financial risk outweighs the technology risk, and the financial gain is a bigger story than the technology risk, that will roll up into financial products that are likely to be distributed by respected brands. Long story short, this technology, when it makes it to grandma and grandpa, who's not going to stake and restake and do all this other stuff, it should feed through into more tailored financial products that suit them, and they are likely to purchase those products through applications that hold the brands that they know and trust.
You could take the view, following on what your line of reasoning, you could take the view that regulation and having cops on the beat, i.e. regulators, actually doesn't prevent financial disasters. I guess what I'm trying to say is that all right, if we just look in the crypto world, we had crypto come onto the mainstream, and most of the activity was happening in CeFi, what we call centralized finance, right? Which is centralized exchanges like Coinbase, FTX, and basically Celsius, BlockFi, a lot of those all blew up, right? When FTX went down, they blew up. People lost. Well, actually, FTX, I think people did get their initial money back, primarily because of that venture capital portfolio that you're talking about. And there was a huge rush to DeFi. So the whole thing was not your keys, not your coins. And so everyone kind of went, we're going to build decentralized exchanges so no one can rug us, and we can't have another Sam Bankman-Fried because there's no Sam Bankman-Fried to control it. All the code's transparent. We can see. And basically, we now see the downsides of that, right? And so people are rushing back the other way, right? And so you have this pendulum you see the same pendulum in finance, right? So I guess what I'm saying is no one can ever be safe. It's always buyer beware. And so let's just.
Yeah, I think there's a few ways to sort of check yourself on the safety metric. So one is when you're staking and restaking and staking and restaking, you should ask, what is the economic benefit of what I'm doing?
You make more money.
Right? No, the economic benefit in the broader system. So when you buy when you buy a meme coin that has absolutely zero utility, you have to ask, what is the underpinning of the value that I just paid for this meme coin, right? So in the same way, you should ask yourself, if I'm staking and restaking and staking and restaking, what is the actual end value creation of what I'm doing? And if you find that there's very little, then that's a good way to tell you're pretty deep out the risk curve. And to some extent, this financial engineering and over-engineering, is to the benefit of the capital aggregation of the application, and only to the benefit of the capital aggregation of the application and the person and the speculator. If there's no broader economic value being created, then that's a really closed loop. It's you getting some more yield in something in non-dollars or non-hard money, and it's you benefiting total value locked of that application. If that's tiny little closed loop, there's not going to be a deep bid when things go badly. And there's going to be risks there that one should think thoughtfully about. I think where you see real value and real use and real underlying collateral, you're less far out the risk curve. And I think most sophisticated investors can appreciate that there's not a free lunch. To your point, much of what happens in the Wild West of DeFi is not something that the masses are engaged in, which is probably a good thing, although I wouldn't want to prevent anybody from doing what they want. And I do think that as we get more regulatory freedom for institutional innovation in the space, you will have higher quality products and higher quality risk analysis that takes place.
So I think we both agree that like innovation, permissionless innovation in DeFi is a good thing.
And should be unfettered.
It should be unfettered, and as it's imported into the masses, that people should be careful.
But people should be careful when they buy a large cap tech stock. I mean, people should know what they're doing. Like, by the way, you could lose a ton of money in lots of ways.
That's exactly where I was going with this.
There's a lot of ways to lose money.
Well, I was going to say, Ian, you know more than anyone that there's a lot of...
And how to lose money? Nice. Appreciate that.
Not how to lose money. That there's a lot of senseless money games where it's hard to detect the economic good or benefit in mainstream financial services, right? And like every 20 years or so, that gets out of hand and it blows everything up, and then we have a recession and there's no milk on the shelves and et cetera, et cetera. Like a lot of, that's why that tweet I read earlier, that's why he posted that picture of the guy in The Big Short, because
for sure
it is shockingly familiar to someone explaining a synthetic CDO squared, right? Where you just had this engineering and then what happened, right? You had a blow up, you had Dodd-Frank, you had this big overreaction to regulation. Now we're kind of swinging the other way where we said, oh, we regulated banks too hard. They've changed. It's different. This time's different. And so
guys, but a market left to its own devices, this is important because like it kind of goes into the future state of the world, right? A market left to its own devices, is it always going to end in chaos?
No, I don't think so. No, I don't think this is chaos. I mean, to be clear.
Well, for the people that lost $300 million, it is chaos.
Okay, but if I'm over levered and I buy Berkshire Hathaway stock, and I'm 10 times levered in Berkshire Hathaway stock, and the stock goes down 10%, and I've lost all my money, that would be chaos for me, but that's not chaos for the financial system.
Yes, but Arbitrum then deciding 12 people, or what'd you say, Dave, 13 people can steal money back.
Look, in fairness to the Arbitrum crew, okay, if you are in a position to know that somebody stole something with 99.9999999% confidence, do you have an ethical and moral obligation to disgorge them of those monies? I mean, you could make a really strong ethical argument here, but we have to accept that sometimes ethics and freedom go up against each other, and that's part of living in a civilization. Those are the non-legal rules that we live by, and I don't know what I would have done if I was one of the 12 wise men or women that sat on the Arbitrum Council. I don't know what my position would have been, but it's still a society made up of people that are trying to decide what the right thing to do is. Now, you can look at that and say, look, I want Arbitrum to make those ethical decisions. I want to support that. I'm going to use Arbitrum. Or you could say, I want to have unfettered freedom, even when I know people are stealing things, because there should be the freedom to steal and to not be disgorged of those monies. But by the way, the most important freedom here is the user's freedom to know what Arbitrum would now do in a situation like this. That's the freedom that's relevant. So now I can say to myself, okay, this is what Arbitrum would do in a situation like this. Now I have the freedom to say, I want to support that or I don't want to support that.
We've talked a lot about The benefits of DeFi. I think we all believe in the benefits of DeFi, or we probably never would have came into this world in the first place. There are also benefits of a hybrid approach, and there's also benefits of a more structured approach for certain use cases or certain people. So, what does the future look like?
I mean, for me, there's composability, instantaneous settlement, global distribution, trustlessness. Those key pillars of DeFi we are adopting today in our technology to bring to institutions behind a permissioned walled garden that manages KYC, manages AML, but gives those market participants those benefits of that streamlined digital experience in what would be otherwise inefficient, heterogeneous markets. We would not be in a position to do that. Doing that today is the benefit of DeFi, is a benefit of DeFi, is building those technologies and bringing them out. Because once you've brought them out, that walled garden that we've created will grow and grow and grow in size to be global, to create that liquidity, to create that efficiency, to improve capital allocation. Once we build the data architecture, we can build data analytics, very much AI powered behind them. But that point of execution, that uniquely digitized, tokenized point of execution that any two wallets, once they are whitelisted, can engage with, is uniquely a function of DeFi. And we are in a position to build on that today because of that innovation.
Yeah, so it's the hybrid. So you're saying the future is hybrid.
Yeah, and I think you're going to see, I think you need to have a lightweight way to digitize and tokenize these technologies for instantaneous execution that's and cash flows that are highly composable. And I think that's uniquely, that's a unique product of DeFi innovation. And I think that's absolutely where we are today. I think this is the moment to be building that.
I agree. I mean, I think, like we're like payments, market making, exchanges, tri-party repo, collateralized lending, uncollateralized lending, perpetual futures, derivative. I think a lot of these things in financial markets adopt DeFi technological underpinnings to make them more efficient and to provide people more access and to build new, better financial services for the masses. Like, I think that's kind of what the world is, that like basically mainstream financial services and markets import the best pieces of DeFi and use them as tools to make existing financial services and markets better, more efficient, more accessible, more interconnected, et cetera, et cetera. But I think that there will always be two ends of the spectrum where you have the Star Wars cantina and people that, are looking for someone to smuggle a droid are going to go there and find Han Solo, and they're going to, whatever, they're going to do their thing. And then you're going to have parts of the financial services that are completely locked, are just stay dusty and old and traditional. Like, I think you just have basically two ends of the spectrum, and whether either of those end, like the size and scope at which those ends of the spectrum continue remains to be seen. But the future is definitely a convergence in the middle.
Yeah, and I like thinking about DeFi as the laboratory, right? And I think that's a really good framework for everyone to be thinking about. It's like DeFi, because of all of the features Ian already rattled off, because of some of the outputs of those features, Dave, that you just went through, but then also because of lack of regulation, because it's global, because it's borderless. It's like that can continue to be a nice little laboratory, even if it doesn't get to massive scale. I know there's some people that believe it will completely rewire everything in the financial system.
To those that say that DeFi is going to rewire everything, I agree over time that's probably true for the attributes I just described. But when we get there, it's not going to feel like DeFi did it. It's going to feel like the financial system just evolved and adopted more and more technology. And by the time you've gotten to that other side of the rainbow, we're not going to be talking about Wild West to the same degree. And so the things that seemed radical or innovative just became commonplace as they became adopted in the mainstream, with an increasing awareness from regulators, an increasing awareness from consumers, better and better applications,
Well, and better
improvements across
governance. You have
government,
to have better governance.
just improvements across the whole every vector that you could think of. But when you get there, it's not going to feel like DeFi took over the world in a revolution. It's going to feel like institutions effectively absorbed that innovation and just stayed the institutions. And whether these are today's institutions or tomorrow's institutions, Coinbase wasn't an institution 15 years ago, but whatever the institutions are of the day that embed these technologies, they're not going to feel like the radical rebels running up the hill. They're going to be the castle on the top of the hill that has this technology embedded.
They won't by their nature, because one of the defining characteristics of permissionless DeFi is that there are no rules.
That's right. Permissionless DeFi. I think when I think about DeFi, I think about the technologies as they can be applied in the permission space. But yes, I certainly believe that we're not going to cast off the permissioned requirements that exist for institutions because of KYC and AML. I'm not predicting that. But I do think you'll see a co-opting and an absorption of the permissionless technologies in the permission space. So
Yeah,
you're
no,
right. There's going to be a cohort of permissionlessness that's always going to feel permissionless. But more and more of the global uses of these technologies will be in the permission space, and it won't feel radical. It'll just feel like
I
what
agree.
the future is.
That's what I'm calling the hybrid.
Yeah.
That's
and
not permissionless DeFi.
make it.
No, permissionless is permissionless. Permissionless is always going to be in a place that's.
Star Wars Cantina, the laboratory.
I mean, I don't know that. Look, I think that this SEC missive is basically going to say that there's room for probably more room for permissionlessness than I may have appreciated even a year ago. That there may be permissionlessness may be more than maybe more mainstream going forward than maybe I appreciated. I still think that institutions are going to have to be permissioned, but we'll see where we go. I mean, there's definitely a more libertarian wind in the air.
I don't see like society tolerating like a world where the stock market runs like a decentralized exchange and we wake up to a news story where it's like JP Morgan's wallet was hacked. All the Tesla stock is gone forever. And like everyone's like, like I don't think that that's like a world that society will tolerate. It's like, oh, where'd the Tesla stock go? It's gone. North Korea has it.
Yeah, I do want to make a really important point that we haven't covered on this call, and maybe it's one that we should have made a lot earlier on. You can use security token frameworks to recover securities from people that buy them, whilst also adopting these technologies. So it's certainly the case that we can tokenize securities with security token standards, and if you lose the keys to your wallet, we can burn and reissue those assets.
Yeah.
And that is, so we can certainly adopt these technologies institutionally and make them safe for mass retail using security token standards. That does fly in the face of the perception that once you've lost your asset or your keys in the DeFi world, they're gone forever, which is probably the biggest hurdle to mass adoption. In the last few years, we've developed really complete security token standards that solve that problem, and we haven't seen their impact on mass adoption yet, but I think we will as soon as in the next year or so.
This is one of the raging debates over this whole thing is like if you strip the asset of its pure bearer nature, i.e. there is no ability to reissue it or reprint it, does that like eliminate one of the main reasons why people are even using it in the first place? So the debate that's happening with Arbitrum is like, 12 people can just decide to alter the ledger. You can make an argument that that's actually like less decentralized than like the normal U.S. financial system where we have an elected lawmakers by 360 million people. They elect their lawmakers, they make the laws, they appoint the judges, they appoint the regulators, and like it probably takes more than 12 people to decide whether your bank account gets seized, right?
You'd like to think so, although I don't know how many judges sit on that FISA court, but
Yeah,
yeah.
yeah, but like
You make a great point. I mean, this is a phenomenal point. You know,
this
we didn't move away from government regulation just so we could have 6 or 12 random people regulate us without any democratic oversight. Like
yeah,
that wasn't the point. You know,
yeah.
you know
So
that
that's a
is
debate that's raging. Like, okay, we did this whole thing because that's good, but did we actually really do the thing that we said, which is like move to this like permissionless realm where there's not any single individual or group of individuals that
right.
can.
And then if you're going to self-police, why is your self-policing more moral or correct than the current policing framework we have in a democracy?
Well,
Like
and
why? Like what? Who made your? Who made you? Who designed? Other than your customer supporting your application, but beyond that, from an ethical perspective, who should be or who has empowered you to subsume those property rights?
Well,
I think
that's I think the biggest pushback on the debate right now is people are like, well, if you have the opportunity to do something good, shouldn't you do it? And it's like, but who gets to define what good is? And this goes very much into like
think it's tricky.
Targaryen thinking, it was good to burn King's Landing type of thing. Like,
Really, Game of Thrones dark.
well, of course, because it's like she thought what she was doing was justified and right. And I think it's just one of the, fantasy fiction is a beautiful,
Yeah, we have
representation of life.
nice. We have a pretty good system in the U.S. to do a lot of things, but that we still need to leave room for innovation to power the engine that is our system. And if people get rich doing that, and people want to speculate doing that, and people make money doing that, that's well and good. I think that the debate itself is really healthy because ultimately consumers will need to decide what their values are and what they want to support. And I think that bringing this to the fore is important. I think we can have a really free society as long as it's fairly transparent and people know what they're doing and people are in a position to be empowered. And so I think flushing these things out is super valuable. I think that separate and apart from the moral, cultural, value-based conversation we're having, there's the technology conversation, which is many, many transactions over many, many dollars worth of value have taken place in this tech. And we know what works and we know where there's risk and we know how to now reuse and reappropriate and build upon these technologies in new use cases that we would never have the confidence to do. And institutions certainly wouldn't have the confidence to adopt if they hadn't already seen so much activity and so much battle tested hardness.
Okay, guys, let's wrap it up.
Cool.
Let's go into the signal. So as a reminder, the signal is using everything we talked about today, this big theme of the episode, which is really, it's a little different from the original theme of the episode, which is no, it's right. What is DeFi in the future state of the global financial system? I think that's really what we covered today. And so we've covered already a lot of what we think that is. Dave, would love to hear more of your thoughts on it. But for the signal, 1 to 2 sentences, what are you watching very relative to this event and to DeFi and how that relates to the worlds we're building in?
I am watching. So this kelp out thing is not over. So I'm watching. So there's still Avi markets are still frozen. There's not been a decision how losses are going to be shared, whether they're going to be and how those losses are handled will determine who actually takes a loss. You have other protocols, Maple, Athena, who have seen huge outflows because of their exposure to this. So I'm watching like how this plays out, how sort of the DeFi markets broadly put themselves back together, recover, who's taking losses, who's not. It's going to be really interesting to see how that plays out. So I'm going to be refreshing a lot X quite frequently and seeing how that.
Is there a way, I know I'm breaking the rules of Signal, but is there a way that it plays out that you think is incredibly harmful?
No, because you know what? Buyer beware. All these people, they took the risk. I have zero sympathy. Like this isn't like I felt bad when people's like 401ks got melted down because, some greedy bankers, created mortgage-backed securities that were shaky. I don't feel bad about this. Like buyer beware. These are all adults. I'm watching it out of interest, but not out of sympathy.
Tough guy, Dave.
That-
No, you make a point. You make a very good point, and I think that goes back to DeFi is the laboratory, right? But that's why yields are pretty attractive over there. All right,
Yeah.
Ian, what's yours?
Yeah. Well, to Dave's point, freedom's not free, but it's a good price to pay, and it's cheap. It ain't free, but it's cheap. Look, I think that this SEC missive is a big deal. I think folks like Dave and I are going to build on the back of it. I think we're starting to just absorb what it means, and I think we are going to see a lot of these new wrapper products come to the market in the next 6 to 12 months, because it's going to be such a lightweight way to achieve market structure goals that have been elusive thus far. And so to me, Kelp DAO is not even going to be, it's going to be a distant memory in people's minds in 6 months. And what the takeaway of this past couple of weeks is going to wind up being was the way in which we have these covered entities sit as wrappers on top of peer-to-peer platforms. And whether those are permissioned, which I think many will be, certainly that's the sphere that I focus on, or permissionless, and we'll see how that looks. I'm less focused on that. I think you're going to start to see a proliferation of these wrappers, and that's going to bring some market structure to places that have really been filled with friction and inaccessibility for everybody, both domestically and internationally.
Yeah. What I'm watching is a claim you made, which is in 6 months, no one's going to be talking about this anymore. I hope that's true. So what I'm going to be watching is we had Apollo and we had BlackRock start to tiptoe into DeFi. What's happening over the next month, 2 months? It seemed like it was almost a snowball effect to where more people were going to get more involved into the benefits of DeFi. And so from a TradFi perspective, so I'm watching to see, does this slow that down? Are we not going to be hearing, or if there were people who were on the cusp of about to make an announcement or about to make an integration, like what's happening there? Are they still going to do it?
This is not a hard one to guess at. Apollo and BlackRock and other institutions want to have as many verticals of distribution as possible. If DeFi is a vertical of distribution, they're going to stay on it. I mean,
if that was the case, then they would have done it 5 years ago. So it's about the timing of which they decide to use those distribution channels.
Yeah, I think that's right. I think you're at a critical mass, and I think the regulatory framework has changed for them. Yeah. And by the way,
and we'll continue to change.
And by the way, changed more in the last 2 weeks. So
that's
what's
what
right?
saying.
So to that point, like if I look at the last 2 weeks, these guys, all these financial institutions want to grow domestic and global distribution. This is a potential means to do so. The takeaway from the past couple of weeks was not Kelp in that regard. It was the SEC thinking about ways that the private sector can innovate.
All right, guys. Good one.